The future of interest rates just got more uncertain. Jerome Powell expressed it more colorfully when he told the annual Jackson Hole Conference of central bankers, economists, and other policymakers that the U.S. Federal Reserve Board was navigating by the stars under a cloudy skies. It summed up the mood of the meeting in Wyoming that concluded at a weekend. Central bankers are unsure whether they've done enough or not enough to shunt inflation rates on a path towards their desired target of around 2%. The Fed chairman provided no insight into whether he thought the Fed's 5.25% point of rate rises in less than 18 months had conquered the worst inflationary outbreak in decades. It left financial market participants in the dark as to whether U.S. rates have peaked or whether they face at least one more rate rise before the end of the year. The uncertainty shown by the speakers at the conference is not just about the conventional question that arises at the tail end of an economic cycle, whether the lagging effect of rate increases makes it likely that the central bankers will, with hindsight, be seen to have done too much and caused unnecessary economic harm. The European Central Bank's president, Christine Lagarde, encapsulated those broader uncertainties with her comment that, in quote, "There is no pre-existing playbook for the situation we are facing today." What she was referring to was a view that the world has changed quite fundamentally since the pandemic and the unrest in Ukraine, introducing some novel unknowns to the already unscientific task of setting monetary policies. There have been changes to our labor market, which are, as she said, historically tied in advanced economies. The pandemic accelerated digitization and vastly expanded remote working, even as generative artificial intelligence has taken off with its potential to both destroy jobs and create new ones. The energy market, particularly but not exclusively those in Europe, have been changed by both the continued response to climate change, the unrest in Ukraine, and the decline in investment in U.S. shale oil and gas. Other sources of structural change include the tension between Russia, China, and the West, the fragmentation of the global economy into competing blocs, and the rise of what is effectively perfectionism as economies respond to both the new geopolitics and the experience of the pandemic. Supply chains that were exposed as fragile and overexposed to a more assertive China are being rapidly reshaped. Whether it is a deglobalization or a more limited restructuring of supply chains, there will be an impact on prices and therefore inflation rates if global supply, including labor, becomes less dynamic and economies become more insular about security than competitiveness. Now, according to Lagarde, the response to climate change and the reshoring and friendshoring of supply chains are likely to lead to a new supply constraint and could see a phase of heavy investment over a relatively short time horizon, one largely insensitive to business cycles. She says the changes of the past 3 years is likely to generate more shocks from the supply side of economies, which will set the stage for larger relative price shocks than seen before the pandemic. If we face both higher investment needs and greater supply constraints, we're likely to see stronger price pressure in markets like commodities, especially for metals and minerals that are crucial for green technologies, and relative prices will also need to adjust to ensure that resources are reallocated towards growing sectors and away from shrinking ones. Lagarde's conclusion is that central bankers will need to be more flexible in their analysis of economic conditions and not as reliant on models based on historical data. There will be a need for new models that capture the complexity that bankers are being confronted with in the new environment. Most of the issues Lagarde touched on are long-term and structural and will require central banks to incorporate a range of new influences into their thinking and decision-making. In the near term, of course, they still have to deal with the current state of their economies. For the Fed, that means grappling with the implication of an economy that, despite 11 rate rises since March last year, is still growing solidly with historically low unemployment, robust consumer spending, and a buoyant share market. Now, Powell, knowing that the Fed can be far off the point where the rate rises hurt highly indebted consumer to the point where growth shows and unemployment starts rising, said the Fed would proceed very carefully. The market took that to mean that there would be no additional increases at next month's meeting of the Fed's Open Market Committee, but that there could be one at the November or December meeting. What the Fed does or doesn't do next matters for financial market. Real bond yields are now positive and at least at levels not seen since 2009. So far, that hasn't affected the share market that was about 4% off its peak last month, but is still more than 15% higher than where it started this year. The bond market's investors are confronted by the wall of supply that looms as the U.S. Treasury raises the $8 trillion it says it will tap market for in the December half, but are convinced market yields will continue to rise. The modest sell-off by equity investors over the past month suggests they too are nervous about a market trading at nearly 19 times projected earnings compared with its historical average of about 16.5 times. And as interest rate rises, the net present value of future cash flows and therefore valuations of companies fall. In the near term, therefore, what the Fed does or doesn't do as it enters the final phase of this particular fight with inflation will have a big impact on the value of bonds, stocks and currencies, and of course on the broader U.S. economy. Longer term, however, the Fed and its peers may have to think about how they respond to what could be regarded as a lengthy transition from the old economic order to the new one, and the complicated impact that will have on growth, employment and prices. That's a very different and more daunting challenge than the already formidable uncertainties central bankers have grappled with in the past and are still grappling with today.